All right, you guys, we're going to get you some information going on so that you can put this information to use. This is just a part one. So I am putting together a part two so that you can see where you can have some practical application to the information that I'm giving to you right now. Right? We don't want to just educate and get information so that you're aware. We want to give you information so that you're aware and you can actually take action. So I'll see you guys soon. All right.
All right, folks. So we can understand this in context. Before we get those receipts, I'm going to get you those receipts. But before we get to those receipts, I want to make sure that you understand a certain definition. Okay, and that definition applies to special servicers. So special servicers and commercial mortgage-backed securities financing. Okay. CMBS loans are pooled together, securitized, and sold to investors on the secondary market as commercial mortgage-backed securities. Therefore, they are not generally serviced by the original lender. Instead, they are serviced by a master servicer, a third-party company that handles payments and communication with borrowers. However, if a CMBS loan goes into default, servicing will generally be switched to a special servicer, which will work to determine if the borrower can once again become current, generally through a debt workout or loan modification. However, a traditional loan default is not the only event that can cause a loan to be sent to a special servicer. Sometimes simply losing a major tenant can cause a loan to be sent to special servicing. The reason being because if you have a major tenant that say like takes up 30-40% of your occupancy space, that can be significantly detrimental in terms of the ability to keep up the cash flow to service the debt. While some special servicers genuinely attempt to help borrowers keep ownership of their property, some servicing companies may do more harm than good. Now, this is some interesting stuff here, folks. It's important to realize that special servicers are only paid as long as loans are in default, creating an inherent conflict of interest between the special servicer and the borrower. Okay? Understand that. That's very key and very important. If the borrower once again becomes current on the loan, the servicing company stops getting paid. Keep that in mind. Okay. Now keep that in mind with how we're going to proceed through the market, how transactions are going to flow. Sometimes it may not be the easiest. You may look at a transaction and say, wow, well, why did it take them so long? This is a possibility. That inherent conflict of interest, very significant. All right, continuing on. Special servicers and pooling and servicing agreements. Okay, again, you'll understand why I'm going through all this verbiage once we start looking at these properties and once you have a better look at what's going on in the market. Okay, CMBS loans are governed by pooling and servicing agreements, PSAs, which name the master servicer, the potential special servicer, and the rights of each of these parties. Okay. Many PSAs give a special servicer the right to purchase property at a discount if the special servicer decides the loan cannot be salvaged, creating another conflict of interest between borrowers and special servicers. In essence, a special servicer may want to see a borrower simply so that they can keep the property for themselves. So you see how these inherent conflict of interest are worked into these deals? It's crazy, folks, but this is the reality that we're dealing with. All this means that borrowers should be extremely careful about defaulting on conduit loans, as it is usually much more difficult to get a loan modification for a CMBS loan than it is for a traditional bank or life company loan. In addition, borrowers should take a close look at the loans PSAs to see what special servicer will be used, as some companies have better reputation than others, right? So that's important, right? Because it's basically saying that you could put it with the special loan servicer and then they can just have you filing paperwork with them for days on end, right? Because every 30 days, that's what we're looking at in terms of the debt default restructuring. When somebody looks at it, they look at how many 30-day periods have gone by for this commercial paper, right? So now it's commercial-backed securities, now commercial paper. So when they look at this, right, they're going to say, wow, this thing has had 3 cycles of 30-day delinquency. That means that they must not be able to suffice. Well, what if they actually are able to suffice to an extent, but the servicer is holding them up intentionally because their buddy is going to be able to buy this at pennies on the dollar. So you see how that could create that inherent conflict of interest, and how you could actually see a very quick downturn in terms of the value of this real estate and all these things being written down. All right, folks, drum roll, please. Here's the juicy part you've been waiting for, the receipts. I want to make mention that none of these that you see are older than April 12th, okay? All these reportings are going to be either April 12th or later, okay? Here we go. April data revealed that a $182 million CMBS loan has gone 30 days delinquent. The collateral is a 667,000 square foot office in Manhattan's Midtown South neighborhood. Receipt. More than 1.4 trillion in U.S. loans will mature by 2027, with some 270 billion coming due this year, according to TREP via Reuters. According to April data, 3 retail CMBS loans totaling 160 million missed their maturity date this month. The collateral contains about 350,000 square feet of retail space in Brooklyn. Basically, they missed their maturity means that the loan matured and they did not have funding. Receipt. Trading alert. Big California office loan goes 30 days delinquent loan with special servicer. April data revealed that the $240 million CMBS loan has gone 30 days delinquent. How many of my folks out here in California with me? Receipt. A $485 million CMBS loan backed by Tishman Sayers 300 Park Avenue in Midtown was sent to special servicing late last month because of imminent balloon maturity default. So that maturity, that imminent balloon maturity is a balloon note. If you don't know what a balloon loan is, basically it's saying that when that hits, that it's all due at one time. Okay, so the loan is for X amount. Let's say you got 5 years. Typical commercial real estate is on a 5-year loan with a 30-year amortization. But if it has a balloon payment, that means basically it's all due at once. Receipt. TREP found that 25% of CMBS loans backed by New Jersey and New York malls were considered delinquent, meaning at least 30 days behind on payment. Pseudo receipt. A $134 million loan on Denver's Republic Plaza has become delinquent. Receipt. $38.18 million loan against Jacksonville, Florida office properties moved to special servicing. Now you see why I went over that definition of what a special servicer was? Receipt. Loan extension request prompts transfer of Manhattan office loan to special servicing. Receipt. $240 million loan against San Francisco's 600 California defaults. Receipt. Now, here's something that's interesting. So we're going to see in this next slide why it's interesting. So, actually not last slide. I'm actually going to go through a little bit of the article so you can understand more in depth what's going on. But public pensions, this is as of September 22. Public pensions have an average of 12.3% allocation to real estate, which is the highest allocation of all institutions according to the 2021 Real Estate Allocations Monitor by global capital advisory firm Holds Wheel in conjunction with Cornell University's Baker program in real estate. Okay, now we're going to go to another receipt. Newsflash, another big SASB office loan heads to special servicing. A $350 million CMBS loan to the list of big office loans recently sent to special servicing. The portfolio backs the single borrower deal. Receipt. Now, this article right here, what we're going to do is we're going to look at the whole thing. Okay, folks, so let's take a deeper dive into an article that's about 2 days old now. As you can see at the bottom right here is April 17th, but very relevant. Why? So pension funds, CalSTRS, California Public Employee Retirement for Teachers in California, brace for write-downs in $50 billion property portfolio. So warning from $306 billion fund That's the full aggregate amount of assets in CalSTRS. It later signed that higher interest rates have upended U.S. commercial real estate market. One of the biggest public pension plans in the U.S. is preparing to write down the value of its $52 billion real estate portfolio. In the latest sign, the higher interest rates are and the recent turmoil in the banking sector are causing pain in the property sector. The $306 billion California teachers retirement system has plowed an increasing share of its assets into real estate in recent years in a bid to diversify away from stocks and bonds and benefit from the superior returns on offer to buyers of private assets. But the fund's chief investment officer told the Financial Times that he is now bracing for write-downs. Write-downs just means that they're marking the value of those assets down to a lower point. Write-downs in the value of assets in its property portfolio and growing evidence that the Federal Reserve's rapid monetary tightening over the past 12 months has knocked valuations in the sector. Office real estate is probably down about 20% in value just based on the rise of interest rates, Christopher Ailman said. Our real estate consultants spoke to the board last month and said they felt the real estate was going to have a negative year or two. So, folks, they're already saying that you're looking at a year or two, right? So we're in an interest rate rising environment. It's estimated that interest rates are going to start going down sometime probably in the second quarter or beyond next year. That's when the Fed may start to decrease in 2024. So basically they're saying out to 2025, roughly, April, that's when we're going to stop seeing that market go down. Okay. CalSTRS is not alone in its worries. State Street Chief Executive Ronald Hanley told Financial Times on Monday that the U.S. Custody Bank's biggest concern was what happens with commercial real estate, particularly office. So you got to remember State Street. So I actually used to work with a company. It was called City Street. It was a joint venture of Citigroup and State Street Bank. So State Street Bank is the largest. It is the largest securities custodial. It used to be, I don't know about now, but 10 years ago, maybe a little bit more, they were responsible for roughly 40% of the custody of mutual fund assets. Okay, so 40% of the mutual fund markets, they were the custodial bank for them. So this is not a small company by any means, and they are definitely rated as one of the systemically important banks that are in our system. Okay, that's just a little side note. But he predicted that commercial real estate woes would contribute to a gentle slowdown in the U.S. economy. Folks, tap in with me in the comments. Do you think this is going to be a gentle slowdown? I mean, what happened last time when we had real estate implode, right? This time they say it's going to be different. Well, we'll see. For CalSTRS, the concerns about property mark a departure for one of the fund's best performing asset classes. Real estate had provided double-digit returns over a 10-year period for the 1 million member plan, according to an update in March. It reported an overall 6.7% loss across its entire portfolio in 2022, in a year that saw both bond and stock markets suffering heavy losses. Real estate makes up 17% of CalSTR's overall assets. Now, remember earlier I noted that it said about the average pension fund has 12%, so they're 5% over in terms of their exposure to real estate. Okay. Its holdings include a $240 million investment in 300 West 6, a 23-story office building in Austin, Texas, and a $1 billion holding in a Blackstone European property fund. Okay, so remember, this exposure is not just in the United States, right? Like, they have exposure worldwide. Remember how I talked about how you have this interconnectivity with all of these different investments? This is what I'm talking about, right? So when you see something going on in Europe, know that it's affecting us right in our backyard. Okay, offices have emerged as a key worry for the global real estate market as the combined impact of rising rates, the shift to hybrid working, and pressure to upgrade buildings' energy efficiency hits landlords, right? So you got these key detractors to the market, right? U.S. office values could see peak to trough falls of about 30%, according to a forecast by consultancy Capital Economics, while prices in the worst hit cities like San Francisco could halve. So they're saying that this could range between 30 to 50% in the value of these commercial properties. Can you guys imagine that?
All right, I hope you guys saw some benefit in that. If you didn't then, well, you'll see it in part 2, which is going to be coming out next, and we'll look at some different funds and some examples on how to actually make money on the information that you just learned.